A nightmare is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the global economy faces an existential liquidity crisis of massive proportions. And in a matter of months, as you're about to see, this is going to impact U.S. consumers in a big way. Now it's over to Bloomberg, where he picked today's story up with a headline: liquidity risks are worrying IMF amid high debt as short-term borrowing during the pandemic is coming due. And one of the challenges here is that governments bought into the narrative that the global economy was going to boom coming out of the pandemic, and so they weren't worried about all the money they borrowed to the extent they've been running massive deficits. Now the challenge is the global economy didn't boom as everyone expected. That here the issue is, see, governments can borrow all they want. The problem is when they do that, they pull it out of the private sector. The issue is going to be, it's not the governments that are going to face a liquidity crisis, it's going to be everyone else. And this year, we're more worried about liquidity problems as many countries borrowed a lot during the pandemic. And that was short-term in nature, and that's coming due. So I think liquidity risks are something we need to pay attention to. Now, what the IMF is actually referring to is the fact that short-term rates are elevated. All these governments borrowed at the short end of the curve. There really is not much of demand to lend this out at the long end, suggesting that they're going to have to deal with even bigger deficits as the bill comes due for all of this debt. Of course, we know governments around the world never want to cut their spending, but that could be what we face as a big nightmare scenario during the next recession, where governments are indeed forced to cut spending at a time when, of course, we know Keynesian economics say that governments need a deficit spend to get us out of a recession. This may be the one time they can't do it. And debt is at extremely high levels. What worries me on top of that is we have projected fiscal deficits that are going to be higher than they were pre-pandemic. And again, this is a major problem, suggesting that liquidity has to come from somewhere. Governments will get it at the sacrifice of the private economy, because at the end of the day, all government debt must be borrowed. It has to come from somewhere. The U.S. doesn't have a sustainability problem. Well, it does to a degree. Obviously, one of the safe asset producers, but when you put too much debt of U.S. bonds in the market, it can crowd out other kinds of funding around the world, and that has implications for the developing world, suggesting that, of course, emerging countries aren't going to get the dollars they need. The equity market isn't going to have the dollars they need. And, of course, the U.S. economy isn't going to have the dollars it needs to continue to run and meet its growth targets. And this is an issue because if you don't have enough liquidity, eventually it leads to delinquencies. It means people can't pay on their debts. And that's the problem. When the government pulls massive amounts of money out of the economy, well, it leaves us with a huge problem. But one thing we do believe there's going to be a lot of sustainability in, and that's the TES sector, as a future of heat storage innovations and thermal energy solutions are indeed going to be the future to deal with the renewable energy problem of excess production. And here we can talk about thermal energy systems offer an efficient method of storing excess thermal energy generated from renewable heat and waste sources. These systems can release energy back during peak demand periods when renewable sources may be insufficient or unavailable. And based on a recent study from Allied Market Research, a global thermal energy storage market is projected to reach $7.38 billion by 2026, with a compound annual growth rate of 10.9%, which makes the stock of one of our long-term sponsors, Brent Miller Energy. And there's a reason we're so excited about this company. We're going to show you what they've been up to this last week. And based on these projections, there's going to be major producers like Brent Miller that are going to take advantage of this. And you can too. Check out their stock on the NASDAQ under the symbol BNRG. We'll show you charts up here in a little bit why we think in the short term their stock's going to move up at 22%. And based on some data coming from the IRS, could send that up even more. And the backdrop, of course, is an environment of markedly elevated borrowing costs that seems likely to endure even if rates begin to fall amid more volatility and inflation that will keep central banks focused on consumer price risk. Of course, this is the issue. We know that in the end of the day, they're going to have to lower rates. Central bankers cannot sustainably keep short-term rates up with governments running massive fiscal deficits. We all know this is coming, but the problem everyone believes is that the bill has finally come due. That's not how the system works at all. In fact, here we can see federal debt inverted, shown in the blue line against the market yield of 10-year Treasury yields in red. And you'll notice that as federal debt rises, interest rates go down. Of course, we know that's how it works because the way a debt-based system works in this case is very simple. As governments take on more debt and pull more money out of the private sector, they have to service this debt and all of their obligations. That takes growth and inflation expectations away from the private sector, which leads to lower rates. In the short term, we've seen everyone jump on the bandwagon believing rates need to go higher. At some point, these are going to come crashing down along with the Fed back at zero. And here we can head over to the ECB as Lagarde says it's likely they will cut rates this summer, again suggesting we have a problem where a global economy is slowing down. We know the Fed is not going to admit this at their next meeting, but here we can see out of Europe they're starting to already realize that perhaps they made a huge mistake. And I would say it's likely too, Lagarde said, but I have to be reserved because we're also saying that we're data dependent and there's still a level of uncertainty and some indicators that are not anchored at the level where we'd like to see them. But the fact that she's saying we're likely to see a cut at, of course, by the summer, suggesting she already knows where the data is going, something we've suggested is happening. And this is, again, setting up kind of what is the nightmare of this liquidity crisis, where all of a sudden the global economy starts to run out of money because the private sector cannot sustain all of the debt that was generated by the governments during and after the pandemic. And this is a huge issue that's coming due. But one place that remains data dependent, well, that is of our sponsor, Bryn Miller Energy. As we look here, they just signed an MOU with RSP Systems, who is now going to be, of course, a distributor, the exclusive distributor in the U.S. Northeast region. We note that they announced this last week, as this will give RSP the exclusivity of Bryn Miller's products in the U.S., which is going to gain traction even more. And according to RSP, they said we work closely with Bryn Miller on the BGen installation in State University of New York Purchase campus. Our firsthand experience with BGen is convinced that this is the best thermal energy storage system on the market, and we look forward to being the exclusive distributor for the system in the Northeast U.S. And all trends point to rising demand for more sustainable energy solutions, and we believe the recently proposed tax legislation in particular will give TES a boost. And one thing we think that this will be a boost for is your equity portfolio. Again, check out Bryn Miller on the NASDAQ under the symbol BNRG. Because as we look at this liquidity crisis that's coming, it's going to impact U.S. consumers in a matter of months. But based on the data out of December, we can actually extrapolate what will happen here by March, as U.S. retail sales rise the most in 3 months to cap the holidays, as the value of purchases rose a whopping 0.6% in December. And this, of course, my friends, exceeded expectations. But one thing to note is retail sales are not inflation adjusted. So as you know, we're going to do that. And you can see advanced retail sales adjusted for the consumer price index shown in blue here. And what we can note that we've noted that retailers were somewhat optimistic. We heard the small businesses, you may remember from the most recent small business report, that they're getting a little optimistic here. And there's a very simple reason why, is because finally retail sales are getting ahead of inflation. This is what retailers and wholesalers were desperate to have. The question is, will it last? The answer, not likely. We still think a further slowdown lies ahead as slowing employment and wage growth feed through, and the lagged impact of higher interest rates takes some additional toll, but there's still little to suggest a sharper downturn lies in store. And that's exactly the case here, because if you think about the consumer, they have to pay on all of these debts. And this is not just the U.S., it's all around the world. Consumers have to buy the debt of the government. So when they get excessive with the amount of money they're borrowing and spending, well, it impacts the private economy. If the private economy cannot grow enough and create enough new money to sustain all the growth and demand for the debt, well, what happens then is you start to see everything enter delinquencies and then into defaults as the liquidity crisis actually hits the wrong side of the economy. If it affected the government, that'd be one thing. They could cut their spending. Private sector, you get a wave of defaults. And what that means is people also hit the unemployment line as there isn't enough money to sustain the labor market. Here you can see inflation-adjusted retail sales, or real retail sales, still in blue against continued claims. So one thing we can note is that consumers came out in a big way during the holiday season and spent like crazy. And now what's going to happen is because they're on unemployment and they have all of this debt to service, that there isn't going to be enough money to sustainably continue the retail sales demand in the economy. That becomes the likely case. Again, this is all about liquidity. And one reason we note there's not enough liquidity is that banks, well, they don't want to lend. And despite the fact that consumers came out in a big way, possibly thanks to the buy now, pay later schemes, what we can note here is the net percentage of banks tightening standards for credit cards, shown in red, says that banks don't want to extend credit. And when that happens, eventually retail sales go. And based on what I'm hearing and what I'm seeing in public when I go out, and what I'm hearing from my friends that work at retailers all around the country, is a demand in January drop. Now, January is the worst month to begin with in terms of retail sales throughout history. It's always the worst. The question is, how bad will it be? As right now, the markets are excited that, of course, December's data look good. This means the Fed's on path to hold interest rates. The issue will be for how much longer before it all comes unwinding. And here we can see U.S. industrial production now edges up to close out a soft year. As we look to see the demand component here, that what we can note is that retail sales really help the economy in a big way. And we can see this in industrial production. We can see this in other factors. So now the question is coming down to when the U.S. consumer starts to give up, when they don't have enough money to keep spending, they can't access enough credit, and the buy now, pay later won't give them any more money. Well, the floor is going to drop out. But one thing that we think is going to continue to edge up, and that is the stock of our sponsor, Brent Miller Energy. Again, you can find it on this NASDAQ under the symbol BNRG. And what we're looking at here is a potential 22% move up to the supply zone. You can see it's been trading kind of range bound. And then based on the last time we had them on the show, they kind of broke out here. There was a pullback as sellers said, no, I want to be and push this stock down, but notably it's holding up where all these buyers have been in the past, suggesting the next move now pushes us up 22% higher. And if the IRS ruling comes out, which we know is coming soon, and it looks favorable for TES Systems, watch Wall Street jump on companies like Brent Miller and send their stock even higher. The 0.1 advance in production at factories, mines, and utilities followed no change a month earlier, as manufacturing output also rose 0.1% in December, helped again by a pickup in motor vehicle production tied to the end of the United Auto Workers strike. Excluding autos, factory production slipped 0.1%. But we can look at the relationship here between retail sales and industrial production, and what we can note when we put both of them on a year-over-year rate of change, you see a wonderful relationship that as demand from consumers remains strong, well, the factories need to keep running and create all of these goods that keeps people in the employment side of the balance sheet. Of course, when this all slows down, then that next thing you know, the shoe will drop. We'll start to see the factory sector lay off. We know that it will impact the services sector with a lag of about 2 to 3 months from now, making the coming months very critical. As we look at factory output, it decreased at an annualized 2.2% in the fourth quarter, wrapping up the weakest year for manufacturing since 2020. And recent surveys suggest the sector is continuing to struggle for momentum. And this is a case we made just the other day, that demand is indeed coming down from the consumer. We should see a drop in new orders. In fact, it's all of the backlogs that's really been keeping people employed. And we talked about this yesterday, that backlogs are dropping too. And as I mentioned here, a Tuesday report from the New York Fed showed factory activity in the state deteriorated sharply at the start of 2024, when the index dropping to the lowest level since May of 2020, one of the worst prints in history. The Institute for Supply Management's broader measure for manufacturing across the U.S. has been in contraction for a whopping 14 straight months. So now it comes down to, can the U.S. consumer continue to spend here, facing a liquidity crisis? The answer is no, because they won't have enough money to continue to spend. They don't have enough access to credit because the banks don't want to lend to it. And at some point, the buy now, pay later are going to find out that people want to buy now but can't pay later. And we can see this still in the factory sector as the data shows capacity utilization, measure of potential output being used, held at 77.1. So now we see the topping starting to come out in capacity as factories are not able to continue to grow their productivity. The overall industrial utilization rate was also unchanged, and both are more than a percentage point below their long run averages, suggesting that indeed the U.S. economy has reached its full potential for the cycle, and now the next move is to the downside. And we look at advanced retail sales against capacity utilization. We're going to show them both here on a year-over-year rate of change. Again, it all comes back to the U.S. consumer. As long as they demand goods and services, the U.S. economy keeps running. Here we can see, of course, capacity utilization ticking up higher on a year-over-year rate of change as retail sales rose. We see that in the industrial production data. Everything tells us that the moment the U.S. consumer decides to stop spending, everything's going to go away. And there may be a big reason that's going to happen in a matter of months, as you're about to see. As year-end bonuses shrink 21%, a sign of turbulent U.S. economy. Now you have to remember that coming into the holiday season, a lot of consumers spend based on the assumption they're going to get a bonus, and they do that thinking that they can pay off a large amount of that debt very quickly in the beginning of the year. And now we're finding out that companies didn't give out bonuses hardly at all. The average cash bonus paid to employees last month was $2,145, down 21% from the previous year. This according to payroll software company Gusto, which tracks payments made by more than 300,000 small businesses. Every industry posted a decline, ranging from 3.8% for technology firms to 36% for tourism and transportation companies. Not only were bonuses smaller, but fewer workers got them in most industries. Small businesses employ nearly half of all private sector workers in the U.S. Of course, that's according to the government. This now facing a huge challenge here because people went out and spent in big ways. They maxed out those credit cards. They did the buy now, pay later. The problem is they didn't get their bonus to pay a bunch of that debt off, and that's going to lead to even sharper demand and discretionary spending at the beginning of the year. And if that trend continues for a matter of months, then watch out. The private sector side of the U.S. economy faces a liquidity crisis as the government continues to borrow massive amounts to support its deficits until Congress and other governments around the world are forced to get their budgets balanced. And at that time, we'll be deep into a recession, and governments won't be there to bail us out. And to be sure, the demand for workers is still strong, but as we're making the case, it doesn't appear that way based on the weekly unemployment claims on a non-seasonally adjusted basis, and unemployment still remains low. The question now is, for how long? But turbulence lurks on the edges, this is according to Nick Bunker, an economic research director for North America at JobSite Indeed. He said job gains are clearly slower than this time last year, suggesting momentum continues to move to the downside, and now you're seeing the nightmare scenario that is coming. The governments have borrowed way too much money, they're pulling liquidity out of the system, and the economies aren't growing fast enough because the banks aren't creating enough new money to support the growth and the debt that we've accomplished, and that is a huge problem. And as always, with any stock company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.